Good morning. I'm Bryce Grabanski with Progressive Ag. Today is February 7th, 2026, and this week, corn was up 2 cents, soybeans up 51 cents, Chicago Board of Trade wheat down 9 cents, Minneapolis wheat down 8 cents. Live cattle and feeders both pushing close to their old all-time highs, up $1.95, and feeders up $7.15. Gold seeing a little bit of a recovery from its fall last Friday, up $2.35, but silver actually sustaining $1.50 losses this week. Crude oil down $1.66, and the U.S. dollar rallying a little bit of a reversal from the previous trend we've been seeing, up 0.7 for the week. First, let's look at the corn chart. Really declined all the way into August of this year, mid-August. And actually, since then, we've been in an uptrend market. We had a sharp reversal here the day of the USDA report. We added some acres way late in January. We added some yield way late in January. Then when most people were expecting it to be cut due to yield issues in the southern belt, but USDA drove their foot in the sand, and boy, markets reversed down to 420. We never challenged our actual low of the year at 410 that we made in August. And actually, if you had bought the day of that report, you're up 30 cents already. We've actually been holding this uptrend very kindly despite the bearish fundamentals put forward by USDA. 2.2 billion bushel carryout, adding acres, adding yield, pretty much all of the things that you could expect. But corn is primed for a bull market, but we haven't seen it. We don't have a spark. We're still treading water when it comes to our lows, sitting 20 cents off the lows for the year. You can make a value play here, but boy, corn crop in Argentina declined 1% to 44%. Good, excellent this week. Brazil and Argentina both had a dry January, but actually that crop isn't under quite enough stress to get us a real bull market here in corn. Actually, the soy crop in Argentina declined more than corn, down 9% this week, but it's still 20% above last year. I don't see a drought issue in Brazil or Argentina sparking that market. But what happened in soybeans is we did get a spark, and it was not what people expected. Actually, we've been in an uptrend market since April. Does it feel like it? In December, we made our highs at 1170, maybe 1175, and boy, we were range bound between $11 and $10 for 90% of the year. We didn't break out until China dedicated to buying 12 million metric tons of U.S. soybeans after they'd bought nothing the whole year. We saw this big rally, sold some of our crop here, whereabouts, and 25% sale, if you remember. Then later on in December, probably December 10th, right about here, we bought back that 25% that we sold because we were thinking, boy, with the fundamentals in soybeans, I don't think we're going to be below $11 for that long. USDA's ignored our yield issues since then. We dropped to new lows. We've been talking about the record crop we've had in Brazil and Argentina, and on that, we just thought that we would sit on the 2 years worth of crop that we've been holding for a majority of the year now, that we bought back in September at the lows of $10 on the November contract. And actually, we finally had that spark. Trump makes a tweet. We're going to try to get China to buy an extra 8 million metric tons, 300 million bushels. Cut our carryout from 350 down to 300 if you believe the other USDA numbers, maybe even 250 if we get some interesting things going. If we have a yield issue, we might even be near 200 million bushel carryout. Now you're talking about some interesting soybean fundamentals again. The market recognized that, shooting up essentially 70 cents since that announcement at the high. Now we closed at 11.15. We put out our first sale recommendation that we've done in a long time. We're deciding we're going to take some chips off the table. Yesterday we put it out. A lot of you got that text message. Sell 10% of your soybean crop at 11.10 or higher on the March contract. We hit that, and actually by the time that you read it on your phones, it might have been 11.30. Almost to 11.40. I think 11.37 was the high yesterday's trade. And it's all speculation at the moment. Nobody's confirmed it. Basent hasn't gone out in the public and talked about it. China certainly would never confirm it because that would make them pay more for the beans that they're obligated to purchase. and they're quite wise buyers. But it's time to start making sales again in soybeans. And actually, you might get a chance to market 2 years worth of soybeans above $11. That is the good news. We've lit the spark in the soybean market. Actually, we may have lit the spark for a multiple years. Not necessarily going to $13 this year, not necessarily going to $13 in the next 6 months, but we're sitting at the 5-year lows in soybeans, essentially 3-year lows. 3 years we've been declining in price. And actually, we'll probably look back at this year as one of the worst time to price any of your soybeans during that time. And so the good news is we're going back into greener pastures with 2 years worth of soybean crop. Now looking at the wheat market, again, wheat and corn have not had the spark lit. We've declined the whole year. We sat at $5 for a brief period, up 30 cents. We've been talking about endless supplies. There's going to be huge crops in Russia. We're not afraid. We're nowhere near tight on carryout. There are all sorts of reasons why wheat should be cheap. And actually, it was the same thing for soybeans not long ago. I wonder how long we will sit down in these areas, how long it will be until we do have a spark lit in the wheat and the corn market. It might be a longer time frame than the soybeans, but boy, what is your risk here? Are we really going to sell out of a wheat crop at $5.30? I don't think that's wise, but you may have to get cash, and you're probably going to pay the price for needing that cash flow. And who knows what will happen from here on out on that, but I'm certainly not making aggressive wheat sales of this year or next year right now. Live cattle market, we've rallied within 5-10% of the old highs, had that sharp drop off. Trump made a tweet, I'm going to import beef and compete you away. And actually, we've rallied all the way back there. The market has been fixated on our tight populations. You look at those cattle on feed reports and the inventory reports, they're all low, right? We've got a 75-year low in the cattle herd. Calf crop was 2% below last year. Fundamentals are interesting in live cattle and actually in feeders too. Feeders, we've got the Mexican border closed. We're not taking in Mexican feeders, and they might have to slaughter them soon. New World screwworm, we're really afraid of getting in the U.S., and so we're throwing money at the border. I mean, they're throwing money at the border to try to keep them out and accelerating that. So I don't see that changing anytime soon. But are we going to be able to challenge those old highs? Actually, I think we have a good shot. We have a nice uptrend here. We probably will challenge the old highs in live cattle and feeders. But how long are we going to stay up there? Last time we got there, we came up with a cheap food policy to try to limit the upside. Our government, during these old highs, were pro-beef producer, very pro, very protectionist, wouldn't let beef from other countries really compete in the U.S. We were making trade deals to ship out beef to other places. We were tightening things. We were really keeping our domestic market protected. That shifted because now our government has two main policies. Number one is keep interest rates low so that we can service our debt. And number two, keep food prices low so people like us. It's a very, very clean-cut sort of servicing that they've been doing. And beef prices, they get to the old highs. Are we going to come up with a cheap food policy to limit that upside? Same thing in feeders, 380 dropped down to 300. Actually, we've recovered all of that back despite this looking like a potential top. We've gotten all that back. I just wonder how long we'd be able to stay at 380. Might not be a bad time to take chips off the table for feeders or live cattle either. Crude oil, we're on that top half of the range. We've seen some pretty reasonable gains since January on tensions between us and Iran, and I suppose Venezuela maybe fueled a little bit of that. And I see our fuel prices are going up. It's maybe worth buying it if it drops back down to 58.60. Right now, we're really at the top fourth of this range, and it's tensions between Iran and the United States. The United States has been pretty dominant in their conflicts. I mean, we destroyed their nuclear facilities pretty easily. We've got pretty good negotiating power in the world, even though people hate us. We've got some leverage. And so I wonder if we'll stay up here for very long. It'll be interesting to see, but not recommending purchasing any fuel quite at this time. Gold market and the silver market have sharply reversed. A week ago from yesterday, on a Friday, dropped down a pretty significant amount. Gold's high is 5,700. We dropped down to 4,500 that day. I mean, we really moved far in the wrong direction on the gold market. We've been treading water ever since, a little bit of gains this week, but that sharp reversal looks like a top. You basically dropped 10% the value from top to bottom, seen a 50% recovery, will probably trickle down from here. I could see that being a pretty common technical formation after something like this. But have the fundamentals in gold changed so much? Actually, let's look at silver. Silver was even more aggressive. We got up to 120, dropped down to 75. Actually, this market is treading water, but quite a bit weaker than the gold market. We never quite got to a 50% retracement from this high to low, and we maybe got 35, 40%, and now we've lowered down to 76 at our close. It's not a particularly attractive time in the silver market technically. And actually, the fundamentals that pushed us to this point where we were valuing precious metals so highly is our reckless government spending. I mean, drunken sailor policy is what we call it. We're collecting $4 trillion a year, spending $6 trillion. I mean, you run a $2 trillion deficit every year. I wonder how long it'll take for the doors to slam on you and your debtors to say, I don't think I'm going to give you another $2 trillion loan this year. Well, we're looking at $38 trillion already, so we've really spent a lot of money that we don't have. Issue is there's two ways to try to avoid that. Number one, you're going to keep interest rates low. You're going to have to service the debt. That's why we're spending a good portion of our budget on just servicing debt. Good portion of our collections on just servicing the $38 trillion that we have already in debt. And so we're trying to keep interest rates low, trying to make it so that we're able to spend some money that we don't have and people won't bother us. And right now the market is basically saying that's okay. We're no longer flooding into silver and gold. The fundamentals that push them there haven't really changed. It's just that this technical top and maybe they were too expensive. I doubt that we're going to revert to $30 silver or $2,000 gold. We maybe stabilize down here at 3,700, maybe stabilize at $50 silver, but I don't see us reversing all of our gains that we've had the past 2 years either. Now, the more important question is, how long is the market going to trade this? In the US dollar, we had a sharp decline, and that's why this money was pouring into gold and silver. Actually, a good portion of Russia, China, our foreign competitors and allies alike we're pouring money into gold and silver. The US dollar declined sharply down to 96 this year from 108 at the start of the year. We had a triple bottom, actually didn't hold. We recovered from there on news of a Fed chair coming back, but are we putting too much faith in that? Are we putting too much faith in the US dollar? Are we really going to be able to turn it around? To me, it seems like neither political party has been a very conservative spender. It seems like both political parties are happy to take our money and spend it in reckless ways. And boy, if you want a low return, just go to government. I think they spend $1 for every 8 cents they make. That's pretty good. And maybe half of that is fraud, as we're starting to see in Minnesota and California. So I wonder how long the market will believe that the U.S. economy will recover, whether the government will make fiscal policy responsible or not. It'll be interesting to see, but the fact is this. We've just got into a time period where we can finally market some soybeans. It's an interesting time for all of us. It's probably time to make some sales on your soybeans if you haven't looked at it. If you didn't take our recommendation to buy back an extra year's worth of crop in September, we recommend you sell 5% yesterday. I'm sure all of you got that on your phones. But that's a summary for this week. I'm Bryce Grabanski. I hope you have a great day and, more importantly, good marketing.